Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bonson's Capital Record, brought to you by National Review, where today we are doing something that we have not done all year and that we actually did every single episode of Capital Record for our first 4 years, whereby we centered the podcast around me having conversations with a guest around a particular topic. And it was a wonderful format and it was a lot of work and we had some incredible guests and I thought provocative conversations, but we switched the format of Capital Record coming into this year to be twice a week instead of once a week, and much shorter episodes centered around a particular given topic that I would drive, and it's been more centered around my own commentary. But I always wanted to leave the option open to continue interaction with guests when so inspired and when it could, logistically be coordinated without putting a burden on resources. And this is one of those weeks where I thought it important, with everything going on right now in terms of the economy, the impact of trade and tariffs. Our Capital Record 2 days ago entirely centered around my ongoing defense of free trade and willingness to continue defending something even when many on the right have decided to throw in the towel and advocate for some form of anti-markets approach to trade. It is important to me that on a matter of first principles, that trade and exchange and mutual cooperation and opposition to central planning be defended. But the real life implications of what has happened thus far with the trade arrangements and deals and tariff impositions from the new administration have big consequences to the economy. And some of them may prove to be good and some may not prove to be good. But I wanted to have a more robust conversation with an economist who I hold in extremely high regard about what exactly the lay of the land is. That economist has been a guest on Capital Record in times past, several times. His name is Dr. Lacy Hunt. And not only is he a PhD economist for 40 years in the domain of monetary economics and interest rates, and himself a very well regarded expert on matters that drive economic productivity, but he also approaches his economic analysis from a matter of first principles, but attaches an understanding of quantitative economics that I think is robust. And I believe that the present conversation about where things stand in the labor market and in other elements of economic category is very important. And I think that this conversation with Dr. Hunt is going to prove to be very informative. So I'll come back here at the end to kind of wrap us up a little, but without further ado, let me welcome back to Capital Record, Dr. Lacy Hunt. So with that said, allow me to welcome back to Capital Record a very special guest, the very first guest we have had of the 2025 calendar year. I couldn't be more thrilled that our first guest revisiting this format would be an economist who's had such a profound impact on me and someone I hold in such high regard. Lacy, welcome back to Capital Record.
My pleasure.
Well, our topic today is to spend a little time thinking about the state of the economy, something that you have written about recently at great depth, and with a particular focus on what we believe the impact of tariffs and trade policy has been thus far, we expect to be going forward. And we're going to bring this to a place where we talk about the really important things, the things we want to look to into the future to evaluate trade policy impact on economic growth. But to do that, we have to sort of start with a baseline as to where we understand the economy to be now. And it's something that I think you have a lot of thoughts on as we try to get a more sober assessment as to where we stand. Maybe start off by commenting on what you think we now know about the state of the U.S. economy.
Well, it's in a far more fragile state than I think is generally recognized. Um, One of the things that we know about the U.S. economy is that the service sector, which is our biggest share, is generally rock solid. It's hardly ever affected uh, by what goes on in the cyclical side. Recessions occur in cyclical. The service sector is steady as she goes. And one of the telltale signs that we're on the precipice of something more serious is that the service sector has flatlined in the last 3 months. That just doesn't happen by accident. And the July numbers were out today and confirming that. The other problem is that the economy, as was portrayed by the critical statistics in 2024, appear to have been very overstated, and not just for the employment, which are probably the most critical of all, but in turn for a whole host of other economic measures. But um, uh, the economy primarily keys off of the monthly employment report, the payroll jobs. But the payroll jobs is a very limited survey, just 360,000 firms. Admittedly, they're large firms, but we have 12 million firms in total. And so the BLS has to go from this small sample to the full sample. And moreover, the BLS has no current information on what's happening to small firms that are being created and are dying. And the BLS has overshot now, or the payroll jobs have overshot the broader full labor market, something called the quarterly census of employee and wages. Its companion, the business employment dynamics, for 5 of the last 6 quarters, and every single quarter in 2024. It looks like that the overcount in private sector alone was just under 1 million. Huge miss. Now, they've had misses in the past. In fact, they had a miss that may have been this equivalent, whether it's the same or a little higher or lower, we don't know, but in 2008 and 2007. And the BLS got a lot of criticism for that. And they reworked this formulation of going from the small to the large full sample. And they said they'd fixed the problem. But as the data is now coming in, it appears that we had a 5 to 7 sigma error, which is very similar to what occurred during the great financial crisis.
Is there a thought that this revision that has just sort of hit the wires last week and obviously evoked quite a response from the president, that it is subject itself to being revised? Will the revision be revised in the other direction, or do you expect that we're now getting a validation of the truth on the ground?
Those counts are hardly ever revised. The BLS may change the seasonal adjustment over the course of time, but the count is the count. Yeah. And the numbers are hardly different. It's the payroll where the revisions are great. And so now the revised picture indicate that the labor market was struggling, was moving ahead, but hesitantly. And it's quite possible that in 2 of the quarters last year, we actually had sequential declines in employment. Totally different picture. And the household survey didn't show this, the strength in the payroll. The National Federation of Independent Business Data surveys from the Conference Board, Michigan, showed a different pattern. And perhaps, not perhaps, but very likely, the best poll of all showed that the payroll data, and what I'm referring to is the exit polls that were taken on election day. because people coming out of the polls just were given 5 choices about the economy, from very bad to very good, and 70% said that conditions were either bad or very bad. In other words, people were very concerned about the economic circumstances, in spite of the fact that the government was telling us the labor markets were resilient. The typical voter didn't believe that. And so I think that as a result, because payroll then is supporting this inverted pyramid. And so if you take the payroll numbers down, then wage and salary income has to be changed, and personal income and gross domestic income, personal saving and national saving. And is it conceivable, if they had a major miss in income, are the income numbers also understated? So we don't know where the productivity figures are. And we also don't know where industrial production is. And so when you have a major failure to capture the labor markets, it tentacles move through all kinds of other economic indicators. And so in the frankest terms, we don't know where we are, but I know this: we're struggling even before this year started.
I think that some who would really like to hold on to at least a reasonably neutral outlook for the economy, or even perhaps one more sanguine, they could try to deal with some of the points you bring up by saying, well, the election exit polls were primarily a commentary on inflation. And this is actually my view on one particular data point. The Michigan consumer confidence, I think, is always a lagging indicator that is not often validated by actual retail sales declining. And retail sales have not apparently declined a lot, as credit markets have thus far held up. And so, being somewhat anti-Keynesian as I am, I've never put a lot of credence in consumer confidence as a leading indicator. But the labor data issue, as you point out, and the upside down pyramid analogy, is important for people to understand how much is predicated in economic data on the BLS labor. Most importantly, as you point out, national income, gross domestic income, but then personal savings and its contribution to national savings, which of course, savings being the bedrock of investment and investment being the bedrock of productivity. So there's a domino effect you're alluding to that is really profoundly important. I guess the question I would have is, given what we could at least agree is a vulnerable economy, people could disagree by degree on if the vulnerability leans to cautiously optimistic, or perhaps others that are even in a full-blown, recession warning camp. There's a vulnerability, and now we're entering a new trade regime where baseline tariff rates are going higher, even with countries that we have formed the framework of a deal, whether they're in the good nation list right now of UK, Japan, European Union, Vietnam. Even those we're going to see significant increase in tariff cost from what they have been. And there's open-ended questions as to where the deal with China will go, which is by far the elephant in the room, perhaps more significant than all the other trade deals put together. But no progress with Brazil, with India, with other trading partners that are significant, not only to the global economy, but in what the cost represents to the U.S. How do you see this playing out, Lacy, in terms of where we are in the U.S. economy and what impact it could represent going forward?
Well, it's very significant. And I think people are going to be surprised when I give you a few numbers. The tariffs in 2024 were somewhere between 2 and 3%. And based upon the latest numbers that I've seen from the budget lab at Yale University, we're approaching 20, which is the highest since Smoot-Hawley. It's back in that neighborhood. Now, to give you an idea, Imports last year were slightly more than $3 trillion, 3.3 trillion, if I remember the number correctly. So if you have a tax of 20% on 3 trillion, you're going to raise $600 billion in taxes. Now there's going to be demand destruction, and so you won't raise 600 billion. But to think about it in another way, last year, corporate income tax collections were just a little bit more than $500 billion. And in the month of June and July, it appears that at an annual rate, the tariffs are basically generating almost a $370 billion annual rate of revenue. These are huge numbers. And these are in no way a small element. They're monumental, and we haven't really witnessed this in modern times. Economists and econometricians have never had an opportunity to look at it. So all we can do is look at it theoretically. Now, here is the sequence that we have to understand: is that the demand for virtually all internationally traded goods is what we call highly price elastic. Very few price inelastic items. Gasoline is, it doesn't have good substitutes. Life-saving drugs don't have substitutes. I'm not an expert in the rare earth minerals, but they appear not to have substitutes. But everything else has a lot of substitutes. So the inelastic goods have something close to a vertical line, but in international trade, it's a gently upward sloping line. And I would say that the majority of items, excluding the ones I mentioned, probably have a price elasticity of 3 or more, which means if you raise the tariff cost by 1%, you're going to reduce quantity demanded by 3. It's a huge hit. And so when you impose tariffs, immediately the aggregate supply curve, or the industry supply curve, if you want to look on the microeconomic, shifts inward, which gives you a higher price paid and a lower quantity demanded. And the instigator of the tariffs wins. But as soon as someone retaliates, and that's happening right now, then what happens is the demand curve shifts inward. And so after the retaliation takes effect, the price level ends up lower than where you started, and the aggregate demand, or the quantity demanded in the micro model, is also substantially lower. But this first round effect, or first and second round effect, also has consequences, because in so doing, there's a huge margin squeeze on the producers. And so what do they have to do? They have to reduce their usage of the factors of production: labor, natural resources, and capital. And so as the process evolves and the margin squeeze occurs, there is what I would call an endogenous reduction of liquidity. Now, most of us assume, as a general rule, the central banks control liquidity. It's exogenously determined. But in this environment, the instigation of tariffs and the retaliation cause an endogenous downward shock to liquidity, first round. Then immediately thereafter, when firms cut the usage of labor, natural resources, and capital, then you get a second endogenous downward shift in liquidity. But the process doesn't end there, because in the process of raising tariffs, what you've done all around the world is that they're a tax, and they're a very highly regressive tax. And so international trades begins to shrink. And perhaps it will shrink significantly because we're dealing with significant sums. And so what happens in that case, global trade volume comes down, and here's the kicker, so do global capital flows. Because the capital account, our net foreign saving, is the inverse of the trade account. And well, why is that important? Well, it's because of the trade surpluses or the current account surpluses that foreigners have been big investors in stocks and bonds and other assets in the United States. In the latest numbers, the foreign sector owns approximately $18 trillion of equities, 5 trillion of corporate bonds, 2 trillion of municipal paper, of MBS paper, and 7.75 trillion of treasuries. So what happens is when the trade volumes come down and the current account deficits improve, then that also reduces the capital account, and you then get a major downward shock to liquidity. And here, because of that, you have to have the correct response from the central bank of the United States. The other banks won't do because we are the central bank of the world. And in the period of the 1920s and the 1930s, when this process of beggar thy neighbor went into effect, the Bank of England, which had played that role prior to World War I, was no longer financially capable of doing so. And so they couldn't provide the liquidity to offset the endogenous shock. And the US central bank was not willing to take up the role. And so and this is called the Kindleberger spiral for Charles Kindleberger, a tremendous economist who wrote a great book called The World in Depression, 1929 to 1939. And he describes this process. And so as the liquidity starts collapsing endogenously, the central bank of the United States has to come in and offset the liquidity, or you'll get deflation. That's the risk.
Is the decline in liquidity that you see coming out through that sequence of events you've described, which, to do a little injustice to it, but try to succinctly recap, is essentially the demand curve moving inward, leading to a reversal of some of the factors of production, capital, but also labor and capital goods, leading to a decline in capital flows, including the foreign investment that is the inverse of our current account deficit, then leading to a liquidity shortage that results in problems throughout both capital markets, risk assets, but the functioning of the real economy. Is this evidenced first in a decline in appetite for treasury issuance? Is it evidenced in a decline for appetite in risk assets? You point out in your latest newsletter, the link of which we'll put in the show notes, that the foreign investment since 2019 was roughly about $9 trillion of U.S. capital stock and public equity. And it's now nearly doubled to $17.5 trillion, about $5 trillion of corporate debt, and I believe it's $7 or $8 trillion of our sovereign debt, the U.S. Treasury issuance. That's significant dollars. Do you believe that that's where it is one of those asset classes where we would first detect this illiquidity you're concerned about?
I think if you look at the period from 25 to 1939, the only thing that stopped the process in 39 was the German tanks rolled into Poland when we started World War II, because everybody kept trying to get the better position. They were not satisfied with the deals that they made, and so they tried in some other way to enhance their position vis-a-vis others. the effects were pretty swift across all categories of assets. But I suspect that that answer is not adequate, and it really depends upon how you value each of the assets. In other words, are stocks fairly valued or overvalued or undervalued, or treasury bonds fair value, or so it depends upon the current level of valuation. But the fact of the matter is, these flows are massive. And ultimately, unless the central bank of the United States offsets the liquidity drain, then we're all going to be affected.
And this is a subject that, of course, Milton Friedman wrote about a great deal. Other economists have focused that study from the Great Depression in particular, with where the central bank not responding in a certain way exacerbated the problem. But just even apart from the historical precedent of the Great Depression, could you explain just in kind of a basic economic sense why the US central bank loosening monetary policy would provide relief to a global liquidity shortage?
Well, because here I use the inverted pyramid example again. Um, if you view the world's financial structure as this inverted pyramid, the the balance sheet of the Federal Reserve is sitting at the neck of that pyramid. And currently, what is happening is the Fed is still shrinking its balance sheet. The critical measure is what I call modernized world dollar liquidity, which is the sum of the system open market account of the Fed and also the foreign central bank holdings of treasuries. Um, like it or not, for the time being, and in the current situation, the world is still the reserve currency of the world is the Fed, is the dollar, which means the Fed is the world central bank. And so they have to accelerate the growth in world dollar liquidity. Historically, world dollar liquidity has grown at 10% per annum in the last 6 or 7 decades. And currently, we're still contracting at a 5% rate for the latest 12 months. The latest week, the Fed shrunk its balance sheet about $14 billion. They're not shrinking it as fast, but they're shrinking it. And so, in my opinion, they're going to have to reverse, or the liquidity drain will trigger the Kindleberger spiral.
But this sounds very different than merely looking to the president's focus has been on his aspiration for Chairman Powell to reduce the federal funds rate, which is, of course, the most common and understood policy tool that the Federal Reserve has to use the federal funds rate and overnight lending to direct the economy either in tightening or stimulus. You're referring really to the balance sheet as a tool for world liquidity. So, in other words, reversing quantitative tightening. And are you thinking that even quantitative easing may be?
Well, let's proceed one step at a time. Let's first of all end quantitative tightening, bring the federal funds rate down, and see whether or not this is enough to offset the endogenous shock to liquidity. But I think that the Federal Reserve is sitting on its hands at a time when it is ill-advised to do so. I mean, I don't question that the first round effect of instigating tariffs is inflationary. But that's only where, and Powell has emphasized this first round effect over and over again. But what he has failed to do is to acknowledge that the second, third, fourth, and fifth rounds are severely disinflationary. And so, uh, from my perspective, it's better to look at the longer term consequence rather than the immediate term. And this dual mandate of the Federal Reserve may paralyze them at a time when they cannot afford to be paralyzed.
I think that what you're bringing up about first round effects being either inflationary or cosmetically inflationary, because even that distinction I think is important. that to the extent we're in agreement with patron saint Milton Friedman about inflation being a monetary phenomena, that targeted price increases, what you're referring to as a first round effect, the item being tariffed, seeing prices go up because of inelasticity and the need for producers to raise prices to avoid margin compression and erosion of profit margins. That those lead to second, third, and fourth round effects that are in fact disinflationary. This seems to me to be a microcosm of a much broader point you've been making for decades, that much of what people are fearful of in a first order in second, third, fourth effects becomes either disinflationary or outright deflationary. And in fact, the thing that people believe they're worried about proves to be far more innocuous than what they ought to be worried about. Is
Mm-hmm.
this
That is
is this
exactly
sort of a
correct. Well said.
microcosm of that story?
I wouldn't change a word the way you said it, David.
No. So my question then is, when we talk about foreign direct investment declining because of the sequence of events you've laid out and the potential for this tariff impact headed in that direction, leading to liquidity shortage, leading to the need of this monetary medicine, is the possibility for a more favorable outcome present in these trade deals if in fact they succeed in opening new markets? Is this talk of new investment from Japan, European Union buying more liquefied natural gas, China buying more semiconductors, us buying more rare earth minerals, is there some green shoots in the reality? I recognize the political messaging is very rarely the economic reality, and my prima facie assumption would be that that's the case here. But is there the possibility that new markets are getting opened that will alleviate this liquidity issue?
I'm not really conversant to understand those deals. I read what was publicly available, and I thought it was very ambiguous. And so to me, what is tangible are the tariffs. We can calculate their impact, and I gave you some calculations earlier. I don't know how to evaluate. In fact, some of the Europeans have said that they can't deliver on the promises that the head of the EU made. So in this particular case, we have to wait to see if they materialize. And that's where I'm just not. I don't have enough information to know whether it's a positive or whether it's um, merely a talking point. I'm not. I don't have enough knowledge.
And I think, Lacy, that brings me to where my conclusion of the matter is that because I think you're exactly right that it's ambiguous. I'm not convinced the White House would know the answer to that either. There's a lot of variables around how some of these things will play out and what form they play out in. Even if a country increases orders, is this coming from foreign direct investment, or is this a byproduct? Does that dry up with the current account deficit declining?
Yeah, that's one of the real problems and contradictions because our current account deficit is going to diminish, which is going to then diminish net foreign saving. And so the EU and Japan and others that may promise this may not have the assets to carry forth the bargain because it, the great lesson that people need to understand what I'm talking about, this linkage between the current account and the capital account, this is not an opinion from me.
Algebra.
It's algebraic substitution. And in other words, if you believe that gross domestic income equals gross domestic product, and gross domestic product is C plus I plus G plus X, if you rearrange it, what you get is that the current account is -1 multiplied times the capital account, or vice versa. They are the inverse. And so how do you have the funds to honor an investment flow if your resources are coming down. It's
And
almost a contradiction in terms.
is it fair to say economics being marginal as they are, it does seem to me that you were using on some of the tariff dollars, and you mentioned the Yale estimate of a near 20% level. Some of those seem to me to be near the peak of worst case scenario. But at 600 billion, just to do the math, at 20% of 3 trillion, and that I assume was on imported goods only.
Yes, goods only.
But if we assume that by the time all the deals are said and done and various carve outs, there are a few line items that are seeing their tariff level decline and we don't know where the Mexico and Canada side of this will net out. If we end up at a blended rate that is 400 billion of cost, that's 200 billion less than the 600, but it's significantly higher than the level we've been experiencing. Are those just marginal changes? The directional expectation would still be the same?
I think that I personally think that the tariff will probably settle in around 15 to 16.
Okay.
But right now, based upon everything that we have, and we keep in mind that we have a lot of it that haven't been settled, and we also have sector tariffs, which complicates the whole process of the computation process. But 15 or 16% is still a monumental impact, in my opinion.
450 billion, Lacy, is greater than the tax cuts that are part of the one big beautiful bill, from 100% business expensing, bonus depreciation, R&D deduction, interest cost deduction. There's a stimulative effect on the margin in the big beautiful bill that I think is supply side and pro growth, and soaking wet, it's estimated to be about 300 billion. So even in a better case scenario of 15%, this would trump that by an extra, this would exceed that by another 150
I think
billion.
your points are well made. I ran the numbers a little bit differently. The CBO has said that the big beautiful bill will add $3.4 trillion to debt over the next 10 years. They also indicated that $3 trillion was the cost of just merely rolling over the 2017 Act. In other words, when you net out all the other good items that you listed, and also the expenditure reductions, according to the latest numbers from the CBO, the effect is 400 billion of net stimulus over 10 years. That's 40 billion a year.
Yeah.
The imports are already running at about a 370 billion annual rate.
Yeah.
And the CBO numbers do not take into account any saving that may have been effectuated by the DOGE effort.
Yeah.
So I don't believe that there is any net stimulus coming net from all of the fiscal policy operations. In fact, we're in negative territory.
Yeah. Well, I think that you've helped listeners to think about this mathematically, and there is an economics behind this that's very important. But one of the things that I can't emphasize enough for listeners is when Lacy made the comment earlier about the current account deficit and its relationship to foreign investment. There are so much that we do economically that's theoretical. There is a necessity of theorizing in economics, and I believe is the height of arrogance to assume that all conclusions economists could ever draw are a byproduct of simple math. Oftentimes we have to have theory and opinion, conjecture, and test it, and utilize method to evaluate how humans act and react, and stay humble. The economics profession needs to be more humble. But when Lacy is making the point about the current account deficit and foreign investment, at that point, he is just simply reading a mathematical equation. And much like some of the work that you've done, Lacy, in the past around monetary theory, we talk about the Fisher monetary equation. These things, when you talk about velocity of money attached to money supply and how this interacts with total supply and the price level, these are algebraic. And I think the most important one you've taught me over the years is connected to this topic today, which is that savings equals investment. And savings is the sum total of private, foreign, and national savings. And national savings is a net of national debt.
Mm-hmm.
Therefore, there is no mathematical escape that excessive indebtedness takes away from national savings, which takes away from investment. And likewise, to your point today, there's no mathematical escape that at some level, foreign investment has to decline at a time when we'll find ourselves in need of greater liquidity.
David, you stated it so beautifully and much better than I can do myself. But I just add one other thing. You have to have the net national saving, as you said, to have the investment. And the investment is the key to raising the standard of living.
Yeah, that's right.
And I want to just give you a couple of numbers. From 1870 to 1970, our GDP in real per capita terms grew 2.3%. And in 1970, the government share of economic activity was 25% of GDP. In the last 20 years, the real per capita growth rate is down to 1.2%. And the government share of economic activity is 35% of GDP.
Yeah.
And so the thing that concerns me the most is that we undertake the government spending, debt financed mostly, almost entirely now, to basically respond to needs. But we don't understand that borrowing the money has negative consequences. And so by coming in to try to solve the problem with debt capital, you trigger the law of diminishing returns, which undermines growth. You also then have the interest expense, which is the dead weight loss. And so when the real per capita growth rate comes down, one of the consequences is that you adversely affect the distribution of income. More and more of the income is skewed to the upper side. And that's not been the key to success in the United States or any other country.
In any other country either. And again, nor can it be in the very nature of things.
Nor can it be. No.
Lacy, thank you so much for your time and your wonderful explanations to lay this out. And I hope you'll join us again here in Capital Record.
I will.
Well, as we used to do in the old days, thank you very much for joining me for that conversation. And I do hope you got as much out of it as I did. I find myself largely in agreement with Lacy. There are a couple of things said here and there that I could be a little more skeptical about or a little more curious about. I am open to the idea that some of the particular trade deals, as he is, may end up generating an FDI that doesn't create the same degree of capital flow problems and liquidity problems that lead to future constraints on growth and productivity. I think he made his case very persuasively, but neither of us seem to me to be arguing for what the exact conclusion will be, rather just framing what the categories of our interest are, what we want to be monitoring and watching to see. Why this matters to Capital Record goes beyond just the mere economic analysis of it. It gets to the fundamental point that I do this podcast for, and that we essentially do economics for in my world, which is a better understanding of the conditions that are going to drive human flourishing. And I think that if one believes that there are trade-offs in economics and that there are just trade-offs we're really happy to take with tariffs because we think they're going to protect one actor against another actor, I would make the argument that that is incorrect, that the picking winners and losers is different than trade-offs. In other words, what we're talking about in that case is a trade-off that is consciously targeted to one actor at the expense of another. What we want in terms of a certain equity in economics is those opportunities that will enable the greatest amount of people, the broadest base, to have the most aspirational opportunity. Not only do I believe that protectionism and the tariff environment we find ourselves in, the rhetoric of it, and in some cases, the policies, not only do I believe that they pick winners and losers and essentially direct us into a central planning apparatus that is counterproductive, but and misallocates resources. But I believe that they weigh on economic growth in a way that hurts everybody, including the people they're intended to hurt. And this is something that opponents of free trade and advocates of tariffs have never understood and never been able to argue around. The extent to which that what they advocate not only hurts all the people I say it's going to hurt, which is enough for me, but it hurts the people they say it's going to help. And I can't understand a willful advocacy of policies that are not only hurting folks you don't care about, but are hurting the folks you say you do care about too. If some of these things go the way Lacy's talking about, where it puts downward pressure on global trade to a point that it impacts foreign capital flows, to a point that it weighs on the factors of production and labor in the economy, then it will be a situation where not only is the distribution of results not favorable, but the results themselves are not favorable. I hope that we can all learn from that, but right now we're going to let it play out a bit and analyze it objectively and honestly, and do so for the aim of human flourishing. Thank you for listening to David Bonson's Capital Record.